Alain, tu viens vérifier si c'est bien celle-là?
Il y a deux, il y a 114 et 111.
C'est ça.
Oui, ça, c'est celle d'aujourd'hui, c'est la nouvelle.
D'accord. C'est ce que je voulais savoir.
Et l'autre,
Et c'est 111, je l'ai. OK.
elle s'appelle 111 et 114, c'est ça. Je ne sais pas pourquoi, bien.
Bon, normalement, c'est fait, c'est bon.
Okay.
Tu vas voir si ça fonctionne, Alain.
Alors, comment je trouve l'autre truc? Students, and I hope the others will join later. So, good evening, everyone. I hope you hear me and you are fine. This is session 2 of the financial analysis course. And in this course, which is again a 3-hour course, we will move slowly from what we did yesterday to some other topics, some new topics. If you see my slide, and I hope you see my slide, and you received them from Mrs. Tuilin at least a few minutes ago. First, we will move from balance sheet to income statement. Second, we'll introduce a few ratios. I would say a few today. We have more tomorrow. And we will go through some specific technical and practical questions coming mainly from the different exams. So this is for the direction. What we did yesterday here is on the second slide, and I hope you see my second slide right now. And what we did yesterday, and I will always do a short summary of what we did the preceding day, in order to understand better what is the main trend in my main direction in my course. We had the presentation of the course with the syllabus. Just to come back to one of the questions, which was raised by two different students. I remember, and it is written in the syllabus, that we have two different kinds of assignments. This one is an exam, final exam. Send really a few, but if you have more questions, I'm ready to answer the questions. And this exam, final exam, is a 2-hour exam. It's made of different and independent parts. In the different parts, you can find questions, but on concepts, but also small exercises. And this is for 60% of the final grade. The assignment will be an exercise, which is part of a case study, which is called biotechnology, and you already received the biotechnology case. And I sent this morning a few lines of explanation about what I want in this assignment. It is a group assignment, but groups are small groups. I don't want groups with more than 2 students. So there is no choice, in fact, right? If it's not individual homework, if it is group homework, but with no more than 2 students, that means it is 2 students per group. So you have a choice, of your groups, but that's one of the main constraints here. And after that, I said you have to make a financial analysis. I don't want more than 4 pages. I want no more than 2 pages of exhibits, appendix, if you prefer, with tables and figures. And I will grade mostly not the calculations, but your diagnosis, and diagnosis will be sentences and no bullet points, and your recommendations to the company, it means to the CFO, and recommendations also to the bank. Remember that it is not, it is not a financial planning case. It's a financial analysis question. It's not a valuation exercise. We'll use a case also for valuation later in the valuation course. So that's what I wanted to say on the syllabus. It was for more information for point 1 here. Point 2, we went through basically presentation of financial analysis. Why do we do that? Who is doing that? How? We went through 6 or 7 slides through the basic methodology, underlying the different steps, and this is what you should use as a methodology in your assignment homework on biotechnology. 4, we spend time on the balance sheet presentation, balance sheet structure, balance sheet calculations, and we went through the main equilibriums, representation of the 3 main equilibriums, the net working capital, operating working capital, and the what we call the cash or treasury equilibrium. And I thought at the beginning of the session yesterday that I will be able to go through exercises on the main equilibriums. I was not, no. And I wanted also to go through a few questions coming from past exams, and I had no time to do that. So I will come back today at the beginning of the session on point 6 and point 7. Anyway, I show you right now what is my plan for today. So it is back on session 1 topics. Just what I said, I summarized what I did. Point 2, it's 6 and 7 on exercises and questions coming from past exams. And then I will move to some other topics, some of them being limited topics in terms of number of slides, some others will be longer. Third one, or point 3 here, is about net earnings. I want to be clear on what is net earnings, what happened to net earnings. 4 is a question, and a question mark, in fact, about inflation. Because this is one of the questions, if you have a look regularly to the international financial news, you understand that it is one of the main questions today. What about inflation? Can we think that inflation will come back after the end of the pandemic, just because of the very high amount of liquidity which has been brought by the central banks in the firms, in the stock markets, and to finance also real estate. Point 5 will be longer. It's about income statement. We have yesterday a presentation about balance sheet. We have a presentation here about income statement with a few questions which are raised, and also discussion on the structure of income statements. This will be, I would say, extended to one of the specific presentation of income statement, including added value. So we'll come back on added value, what it is it for, who are we users, what is the connection between micro economy and macroeconomy. It means between the firm and the goals of state governments. If we have time, we go through mark-to-book values and the presentation and discussion there, and I've got an exercise also, and we will finish the session with a few past exam questions, a bit more complex than those I prepared for session 1, and we will deal with in a few minutes. So that's the organization, that's the structure of the session. So now I move back to my slide on session 1. On session 1, we are somewhere here. Here, yeah. So I hope you see my slide. Yeah, partager, that's it. And I want to move to the last slides, because we went through all the slides on the balance sheet. We went also through the equilibrium definition. Do you see my slide here? Balance sheet equilibriums, that's okay? If I don't have an answer, my hypothesis is that the answer is yes. Okay. And I was here yesterday evening at the end of a presentation with the basic relations between the net working capital and the operating working capital, which allow to calculate the level of the cash position of a firm. And the second point here, before having a look to the ratios, was to say, okay, this is true. We can demonstrate that it's just an arithmetic calculation. It's very easy, but it is static, and we can bring kind of dynamic dimension. It means the modification of the treasury level, treasury position between 1 year and the preceding year is equal to the modification in the net working capital between these 2 years minus the modification in the operating working capital. So, and the conclusion was about ratios, and I said a few words about 3 main ratios used with net working capital and operating working capital. The 2 first ratios being comparison of the net working capital and the operating working capital to sales, and the third one being the comparison between net working capital and operating working capital. Just in order you understand very well, that the first one, net working capital over sales, is of course calculated without VAT. It's a question of homogeneity. Okay, there is no VAT included in the calculation. Yeah, and it brings some kind of measure of security. That means, in fact, you have net working capital in excess. In fact, it means more total equity and long and medium-term financial resources debts than investment, and leave you as a CFO with an excess of net working capital, which can be used to finance any other asset, generally inventory first. And when you increase this ratio, you are safer, or at least the CFO is safer. Okay. It means its liquidity risk is decreasing. But there is a drawback. Very often when you have something which is maximized or minimized, you have a drawback somewhere. And the drawback is in the return. If you increase the return, if you increase the value of the ratios, that means to increase the level of the long-term and medium-term financial debt, but also of the total equity. And very quickly you will see a decrease in the return for shareholders. It means the return on equity will decrease. So we need some kind of trade-off, some kind of equilibrium between the goal, the safety goal, security goal, liquidity goal on the one hand, and on the other one, the maximization of the return. And we have measures of that, which are brought at least for economic sectors, and give you some idea of the policy to follow. The operating working capital over sales give you the need of financial resources needed to produce what you will sell. It means when it is very positive, it means you have to finance inventory and receivables, which are not financed by the operational debts. It means which are not financed by the debt to staff, the debt to tax administration, and the debt to the providers. That means you have to bring some cash coming either from an excess of net working capital or from short-term financial debts, it means generally from the banks. And the this ratio is high, it means you need more long-term resources, more equity also, and that brings as a consequence a reduction in the return for the shareholders. If you have a high ratio, but a low percentage financed by the net working capital, that means that the operating working capital will be financed mainly by short-term debt, and that the company has to negotiate regularly with the banks and is not really independent from the policy of the banks. So again, we have two principles here. The first one is to try to reduce the operating working capital on sales. Of course, if the ratio is equal to 0, it means there is no need for more financial resources and the problem is solved. Same if it is negative. If it is 0 plus, it's easy to finance generally by short-term financial debt. But when it is high, 25, 30, 40% sometimes, that means the CFO and the company has to develop a plan to reduce the operating working capital with the new policy for inventories, a new credit policy for receivable, and new negotiations, with providers. And of course, you need to keep some kind of equilibrium there, with perhaps an operating working capital being positive, because if you want to sell, you need to bring credit to the customers. This is the tradition in your economic sector. But at the same time, you need to be in a situation, this ratio is not too high, that has not for consequence that the firm is dependent from the banks, or doesn't use too much equity. That means doesn't reduce too much return for shareholders. So it's something very, very important. And in many companies, you find regular goals of reduction of the operating working capital. 1 year with a better management of the inventories, a year after with new negotiation with customers, and the 3rd year, new negotiation with providers. This is very, very central. It gives us also, some ideas of the capacity of a firm to develop its operations. It means if you have a 0 plus ratio here, that means that if you increase your production in your sales, the need for new financial resources is very limited and can be solved easily. If on the contrary, instead of being 3 or 5%, is 14%, that means for each monetary unit of sales, you increase your total level of sales, you need something like 40 cents of new financial resources. That means it can become very quickly difficult to assume. So this way should give also a reasonable approach of the to the question: is this firm able to finance a growth? A growth company is a company with a low operating working capital on sales. Mature companies can have higher ratios, but generally, their return is also going down progressively. The third ratio here is net working capital divided by the operating working capital, and it comes back to the idea I just developed. What is the percentage of the operating working capital which is financed by long-term resources? And of course, if you say it is 60%, that means that 40% is financed by the short-term banks, short-term financial loans coming from the bank. So we can measure the degree of dependence, from the banks, and you can measure also the consequences here on the return for shareholders. So this is very important. Remember also, I said a few words about some specific industries, in particular in the distribution activities, economic sector, you will find negative operating working capital. Modern distribution is generally the example which is given. That means each time the company is increasing its level of sales, you find a higher operating working capital with a negative sign. The absolute value is increasing, but the sign is negative. That means instead of consuming resources, the increase in sales is bringing new financial resources. And if you have a look, and we'll come back later on that case, to the balance sheet of the distribution sector, you understand that part of the investment themselves are financed by the operating working capital. Because even if it is, made by current assets, debts, they are, for part of them at least, for a large part of them, stable over time, which means they can be used as long-term financial resources, non-current, as we say in many books. And this is, of course, the less costly kind of resource you can find. So, distribution sector, when firms are well managed, are in a very positive trend, very positive trend to grow. Very often you will see that new supermarkets are just financed, when they are created by the operating working capital. It means by the cash coming from the other supermarkets. You create a supermarket, another one, third one, and 2 years after, altogether they produce cash in an amount which is enough to finance, the creation of a fourth one. So when growth is well managed, the operating working capital with its negative value brings the financial resource needed to extend the number of supermarkets open working in the country. So I just wanted to come back because it's not so easy to understand from most of you, I think. And now let's have a look to these calculations here, which are basic calculations, but at least you have to go through that kind of calculation once in this course. So it is an example, and you have this data here. We have a limited number of data, and calculation will be very easy to go through. Let's read together part 1. The airline company has got in its balance sheet, year N, 1,500k euros in medium and long-term debts, 2,500k euros in total equity, and 2,800k euros in net fixed assets. The level of inventory is 1,100k euros. The level of receivables is 500k euros. And the total debts to provide the staff and tax administration, which is generally VAT, mostly VAT, 900k euros. the amount of cash included on the left side of the balance sheet is 700k euros, and the total amount of short-term financial debt is equal to 200k euros. The financial manager asks you to calculate the three main key divisions for the balance sheet at the end of your end. It's very, very simple, calculation, and it was the first part of the first question, in fact, of an exercise I gave in one of the past exams. Let's go through the calculations here. So you have the data in part one on that side, and now on the following one, you get the calculations. I hope the calculations are correct. So the net working capital is equal to what? Is equal, remember that, is equal to total equity, which is 2,500 here, plus long and medium term debt, which is 1,500. And of course, this is supposed to finance the investments and the level of fixed assets, which is the investment accumulations in the balance sheet is 2,800. So the calculation is very, very simple. It's very basic. That means you get 2,500 plus 1,500 minus 2,800, which is equal to 1,200k euros. Which means I want to clarify the calculation, but the best company has a net working capital, which is 1,200. That means there is an excess of long-term financial resources compared to the level of investment, at least as they are taken into account in the left side of the balance sheet. That means when you are in that kind of situation, these resources can be used to do something else. And generally, they are used mainly to finance inventories and receivables. Okay. Some cases, excess, means the level of net working capital is higher than the total of the inventory and receivables, and that means that you find cash, in the bank's accounts, and cash, in the left side in the balance sheet. Let's see what's happened in that case. Let's calculate now the operating working capital. Let's come back to the preceding slide, and we find, here we find the different elements. Total level of inventory, which is the largest one, 1,100. The level of receivables, 500. And the total debts to providers, staff, and tax administration, which is 9,000. And that's the information you need. And the question is, does the total debt to providers, staff, and tax administration is sufficient to finance the inventory and receivables? Or does this level of operation implicate and need some more financial resources coming either from the net working capital and or from the banks? So you calculate the operating working capital, WC here, and this is 1,100 for the inventories, 500 for the receivables, and 900 for the operational debt, and the difference, and total the difference here are for 700k euros. That means, the operations are structured in such a way that 700k euros are needed to finance the operations, and they should come either from the upper part of the balance sheet, the net working capital, or from the banks, short-term loans from the banks. So, of course, you remember what we did on the relations between static relations between the treasury position, the net working capital, and the OWC, and we get T here is equal to 700 minus 200 equal 500k euros. That means there is an excess cash position, positive position of cash of 500 euros. If you take into account to make the calculation, the cash which is available and the bank account in the balance sheet and the level of the short-term financial debts. Of course, you can recalculate T another way, both ways. You can do it through the difference between the net working capital and the operating working capital, or using the position in the balance sheet of cash and short-term financial debt. And of course, hopefully, you find the same number at the end, which is 500k euros. So we have a company with a positive net working capital, positive operating working capital, a positive value for T, and the operating working capital, 700, is financed. It can be financed only by the net working capital, or if part of the net working capital was used to finance, for example, a new investment or an acquisition, it could be also financed partly by the short-term financial loans. Let's have a look now to the equilibrium in the year after, which is N+1. All the calculations we have been through here are for year N, and we have few more data here in part 2 of the exercise. We have few more data for the year after, which is N+1. Let's read to what we know for year N+1. In N+1, the CFO issues new shares for 500k euros and increases the long and medium-term debt level with a new loan for 100k euros. That means during this period, we will increase the long and medium-term financial resources by 500 plus 400. It is also decided to invest in production equipment for 600k euros, and the inventory during the period, year N+1, increased by 200k euros. So we have a new investment to finance, we have an increase in inventory, which means here, because all the other elements of the calculation of the operating working capital stay constant, stable, we have a financial need of 200 euros to finance the operating working capital. CFO asks you to calculate the new equilibriums and the modifications between your N and your N+1. Okay, so let's go back to calculations here. N+1. Net working capital. What's happened to the net working capital? You still have the initial data, the 2,500, the 1,500, the initial long-term financial resources, equity and loans. You find again the 2,800 for the fixed assets, but we added here 500 and 400 for the long-term financial resources, equity and loans. And also, we added the 600, yeah, which is investment in production, production equipment. So we have taken into account all the modifications, and the new net working capital, your N+1 is 1,500. Okay. For the operating working capital, we have still have the preceding data, and we have an increase in inventory of 200. That means, you know, the result for the calculation of the operating working capital is now 900, and you can compare the 900 to the 700 above. You find the difference of 200. Okay, so you can calculate T directly with preceding calculations. It's equal to the net working capital in period N+1, 1,500 minus 900. The new value of the operating working capital, which is and the result is now 1,500 minus 900, which is 600k euros. If you compare with the preceding value of T, it was 500. It means there is an increase in cash available of 100k euros. So the company was able to finance the new investment and at the same time to increase the net working capital, which is probably good news. The operating working capital increased also because of the increase in inventory, and the increase is 200. But if you compare the increase of net working capital and the increase in the operating working capital, with a difference of 100, you find the 100 in the cash position. But it also, if you compare the net working capital and the operating working capital in your N and your N+1, it brings you to the conclusion that the situation is better in your N+1 than it was in your N. That's what you can get from that kind of basic calculation. So here we are. Now, you have a summary of what I just said, you know, on the modifications between N+1 and N, 300, 200, and 100 for the three main equilibriums. It means you have measures in N, measures in N+1, but also you can find the value of the modifications in the three equilibrium. And you have a conclusion I just mentioned a few minutes, few seconds ago. That's what I wanted to show. I will come back later on the ratios. So this is what I wanted to show you on the three main equilibriums, which are very essential, you know, in financial analysis, and which are used, as I did, with a static approach, with a dynamic approach. It can be used to forecast one of the three elements using the basic relation, you know, for the year after. It's always done. It's very often done, at least. And of course, it can be used in a ratio analysis. But let's keep the ratio analysis for tomorrow. Now, a few questions. It's a test for you. It's also an opportunity for me to bring some more elements, you know. think you can see that. First question here. Fixed assets. I have four questions in this first part, and I have another group here, 4 questions in the second part. First one is the following one. Fixed assets are counted at full acquisition price. Full acquisition price, sorry for that. Yeah, later. But VAT is not included. So this is something very simple. We went through this point yesterday. When you introduce in your accounting system and let's say here in your balance sheet, any kind of investment, whatever it is, could be the classical production equipment, transportation equipment, can be a building, can be land you buy, it can be a financial loan you give to one of your subsidiary, one of your customer, I mean long term here, it's more than 1 year. Or it can be any kind of intangibles, from a brand to a patent to any goodwill due to an acquisition. There is never VAT, it's never VAT included, it's VAT excluded. That means for the most simple case, when you buy an equipment, production equipment, to a producer, they send you an invoice with VAT. For example, if the price without VAT is 100 and the VAT rate is 10%, you pay 110. So cash amount you pay is 110, but in your accounting system, you just mention the value without VAT here. So it will be 100. So all assets, all fixed assets, investment, if you like, and the accounting system are taken into account without VAT. There is no exception to this basic principle. Remember also that the accounting system has been designed for owners. I mean, you introduce in your balance sheet the production equipment if you are the owner. If you have signed a contract, you contract to buy the production equipment with probably the producer of the equipment. Okay. If you rent only the equipment, it is not there. It means that you pay rents, and rents are included into the income statement. The only difficulty we have right now, and we'll come back on that later, is with some kind of leasing contracts. But we have to be very careful, because only we have 2 categories of leasing contracts: operational lease and financial lease. A part of them, are included in the balance sheet. Another part is not included into the balance sheet and is managed in an accounting point of view as a classical operation of rent. We'll come back to the point. So this was for point 1. That's what I wanted you to explain. Then the element of the answer is no. There is no VAT included at that level. There is no exception, as long as, and first point, and second, as long as the firm is the owner of the asset, it has to be included into fixed assets here without VAT. If it is just rent, it has not to be there. It is managed on an accounting point of view, including the rents paid every year in the income statement. And we have a specific case, last point, with leasing contracts with two categories. And one of them is managed as if the firm was the owner, it means it is included into the balance sheet. And for the other one, it is managed as a classical expense, as a rent. So we have several cases, but the main principle is the fixed assets you own is always integrated in fixed assets and without VAT. Point 2 here, are interest to be paid on long and medium-term debt included in the balance sheet? And the answer is clearly no. There is one exception, but in 95–97% of the cases, it's no. You integrate into the balance sheet on the right side in the long-term financial debt, the amount of the debt, not the amount of the debt plus the interest. Interest are paid generally every month or every year, and there are expenses which are integrated into the income statement. Okay. There is only one exception. It is the case where interest are capitalized for years. This is, for example, the case of what we call zero coupon bond. The example is very simple. You get a loan as a CFO from your bank for 100, and the interest rate is, let's say, 5%. It is a 5-year maturity loan, and it is a zero coupon. What does it mean? It means as a company, you don't pay anything for the first 4 years. And during the last year, or at the end of the last year, you pay back the amount of the loan plus, the interest you didn't pay for the 4th year, plus the interest of the 5th year. What will happen there? At the beginning, in your year 1, your debt will be 100. 1 year after, if you have an interest of 10%, but you don't pay the interest, your debt is now 110. And in the balance sheet, you have a debt of 110. At the end of the 2nd year, you should have paid 10%, not only on 100, but also of the interest of the 1st year. It means 110. So your debt at the end of the 2nd year is 110 multiplied by 1.1. It means 121. So in that case, but this is an exception, the interests are integrated, it means interest which are not paid, are integrated in the total debt level and are integrated into the balance sheet. And the total amount of debt from year 0 to year 5 is increasing every year. But this is an exception. In the classical loans you find, which are either annual repayment or constant annual payment or constant annual repayment. You have two cases. The amount of the debt in the balance sheet, it doesn't contain the interest. The interests are paid every year, integrated into the income statement, and on the balance sheet side, progressively the amount of the debt itself is decreasing and is going down to 0 at the end of year 5. Is again, maturity is 5 years. So you have a general rule with an exception. This is what I wanted you to understand. The general rule is that the interests are not included into the balance sheet with the income statement. The exception is with zero coupon bond. And in zero coupon bond systems, from year 0 to year 5, in the case I choose, you have the initial loan plus the interest which are not paid, which are integrated into the balance sheet, which means that from year 0 to year 5, the level of the debt in the balance sheet is increasing every year. And at the end, one shot, everything disappears, the initial amount of debt, and also the capitalized interest over 5 years. So that's what you have to explain. I've got for you a question 3 here, which is probably easier if even the explanation here is longer. Often companies pay their suppliers with a delay. That's classical. In many economic sectors, if you are a newcomer, if you want to sell, you have to adapt to the tradition or rules of this economic sector. Well, for example, producer gave 60 days credit in average to their customer. And if you want to reduce to 20 days, for example, it will be difficult for you to sell, just because, in fact, your customers, they pay with the product of their sales, but they don't have the cash necessary to prepay, in fact, their own sales. So you want to live, you want to survive, you have to give, your counterparts, customers or suppliers, credits. You have to give a credit to your customers and to obtain a credit for your supplier. So here it is explained that often companies pay their suppliers with a delay. That means, for example, a distribution firm, and the distribution firm, they pay the producer of textile article with a delay. So the problem is what to do with these credit obtained. These debts are included in the right side of the balance sheet. Right side of the balance sheet is part of the OWC calculations, it's accounts payable, what we call accounts payable, and the problem will be what is the value of these accounts payable. If you read the next sentences, you read that companies are often paid by their customers with a delay. These debts are included in the left side of the balance sheet. That is receivables. Now you have accounts payable and you have receivables. The question is, do these debts to the suppliers and from the customers take into account the value added or added value tax or not? Explain. Because of course, in both cases, if you have a firm, you give a credit to your customer. If you are a firm, same firm, you obtain a credit for your suppliers. Okay. In the first case, it is receivable. The second time, it is payables. Well, now, do these numbers are without VAT or with VAT? Remember what I said yesterday on the presentation on the balance sheet. This is the only case in the accounting system where we find numbers including the VAT. The only case. I mean, if you sell textile articles as a producer to a distributor and you give them in the negotiation, after negotiation, 60 days of credit, you will have in your balance sheet, receivables for 100 plus the VAT on the 100. If it is 10%, it will be 110. Okay. You will not keep, of course, this level of 10. You will obtain, will be paid of 110 by your customer, and you will transfer, you will pay back to the tax administration the 10, the number, the 10 level. Okay. On the other side, it is just the same, if you obtain a credit from your raw material provider, it will be an invoice with VAT, and you will introduce in payables the level of the invoice, including VAT. So in this question 3, the interesting part is that all these invoices between firms, are taken into account at the balance sheet levels as receivables and payables with VAT included. Then this is an exception in the design of the balance sheets. Point 4, this is also something we have been through yesterday. Inventories are accounted at full acquisition price and VAT is included. Discuss. It's a question which is not always very often understood, but inventories, are not considered as receivables. You buy raw material. You have an invoice with VAT. You pay, of course, perhaps with a delay. You pay with VAT. But what you include in your inventory level is the level, the amount of the invoice without VAT, always. So if you read the question here, you will say, no, this is wrong. These amounts are not included with VAT. They are taken into account without VAT, always. There's no exception for inventories. But are they accounted at full acquisition price, which is another question? The answer is yes. And full acquisition price is a price which is on the invoice without VAT. So be careful, because in this tricky questions, you have a yes and a no. it's yes, I agree. Inventories are counted at full acquisition price. Okay, we have been through the discussion yesterday. If you buy outside, it is the price which is on the invoice without VAT. If it is an intermediate product, you introduce the cost of all the elements included into the intermediate product without VAT. And second point, in any case, VAT is not taken into account, is not included in the inventory level, which are registered in the balance sheet. So this was for first group of questions, and I had a second group of questions for you. Second group of questions, a bit more difficult here. Four questions again, very different questions, very classical questions in financial analysis. But first, let's start with number 3. Yeah, we'll come back to the two first questions in a few minutes. We have 4 questions, and I start with number 3, and number 3 and number 4 questions are questions on depreciation and amortizations. Number 3, are depreciations included at the same time in the balance sheet and in the income statement of a firm? Explain. Are depreciations included at the same time in the balance sheet and in the income statement of a firm? The answer is yes, but not the same way. If you buy, for example, again, a production equipment, and for 100, the production equipment is submitted to depreciation rules with a linear scheme on 5 years, that means that each year it will be depreciated of 20. So the gross value at the beginning is 100. At the end of the first year, you have a depreciation of 20, and you have a gross value which is still 100, but net value which is 100 minus 20, which is 80. Now at the end of year 2, you have a new depreciation for year 2 of 20, and the gross value is still 100, but the net value is 60. And the year after, which is year 3, the gross value is 100, still 100. The depreciation of a year is 20, and the net value in the balance sheet will be 60. What does it mean? It means that annual depreciations will be first taken into account in the income statement. It means in my case, you will find for this equipment depreciation 20 from year 1 to year 5. And of course, at the end of the 5 year, you will have depreciated the asset by 100. If you go back to the balance sheet, that means that the gross value is still the same from year 1 to year 5, but the net value is decreasing by the level of the depreciation each year. It means it is 100, and next 80, next 60, and so on. Okay. And at the end of the 5th year, it is 0, net value is 0. And of course, the accumulated depreciations are 20 the first year, 40 the second year, 60 the third year, 80 the fourth year, and 100 the last year. So depreciations, are taken into account in the income statement and the balance sheet, but not exactly the same way. It's only annual depreciation which are integrated each year in the income statement. In the balance sheet, it's a bit more complex. Of course, you depreciate the gross value by the level of the annual depreciation each year, but in fact, you understand that the total depreciation accumulated in the balance sheet is increasing every year. First year is 20 accumulated depreciation. The second year is 40. Then it is 60, and so on. Okay? And of course, the net value is going down. That's what we find. It's not that easy, difficult to understand. Question number 4 is a bit different, It's on depreciation and amortization calculations. Let's deal with depreciations, and we'll come back on amortization later. Where is it coming from? When do we have depreciations? We define the rules of depreciation in order to take into account of the quality of the assets. I mean, if you have an equipment you produce with the equipment, after a few years, the equipment is not so productive as before, and it is not also as competitive before. You find innovations and the new equipments will do the same thing, are more productive, are less costly, are easier to use, are more flexible, and so on. So that means, the value of the equipment is not after 3-4 years what it was at the beginning. This is the first point. The second point is that, okay, if you have an equipment and use the equipment, bought and paid 100, if the economic life of the equipment is 5 years, that means that at the end of the 5th year, you have to buy a new one. And you need resources to buy a new one. And the system is made in order you can accumulate without paying taxes the amount necessary to buy a new one. But you understand that in most of the cases, you will not buy the same one, but another one, which is more modern, let's say, more productive than the one you bought 5 years ago. And you understand also that probably the prices will not be the same. Prices can decrease if there is competition in the market between the producers, or it can increase in case there is limited competition and the producer dominating the market brought some kind of very useful innovation. So, at the same time, depreciation are supposed to take into account of the economic value, economic use of the production equipment, but also it's a kind of non-taxed resource which can be accumulated to renew the equipment after the end of its economic life. So this is the principle. And after that, we have tables in many countries. It means we have civil servants, which are supposed to know everything. And these civil servants, they have produced tables of depreciation for each category of equipment. Means a lorry is not depreciated like a car. The equipment for production in the pharmaceutical sector is not depreciated as research equipment, and so on. So each equipment in each industry has got its own rule for depreciation. And this is partly, the tax rule, because you should not forget that these depreciation are deductible from the the operating earnings submitted to taxes. So there's a tax rule principle behind, and it is supposed to be also an economic proxy of the economic depreciation of the asset. So these two elements, tax-free and proxy of the real productive life of the equipment, give you an accounting table which has to be applied. So it is an accounting rule, but based on an economic forecast and a tax rule. So remember that depreciation can be different also from one country to the other. You take the same production equipment in Vietnam and in Thailand and Malaysia, make some time a comparison, and you will see that, the rules could be different. In one case, it will be on 5 years, second one will be on 4 years, one will be on 6 years. It means, this is the result of the introduction of the tax rule and of the economic forecast of the proxy of the economic use of the equipment. So this is what I wanted to tell you on depreciations and that level. Question 2, it's quite easy to understand, even if the words, are non-understandable for non-accountants. The question is, accruals and deferred are used to recognize revenues and expenses booked in one period but relating to another period. Are they accounted for? Okay. You can have, situations where, for example, an equipment is paid in advance on the month of December, and in fact, the invoice and the delivery of the equipment will be done in February the year after. So you understand that somehow you have to take into account the amount of cash which has been received, but you, as a company, you are not the owner. You did not receive the invoice. You didn't receive. You have not. The equipment was not delivered. So we need some kinds, of specific, rule to integrate into the accounting system this payment without delivery and without invoice. On the contrary, you can have a situation which is just the opposite. You have a delivery, you don't have the invoice, and it is not paid. So I don't want to go into the detail, but let's say we have specific rules and names of accounts to deal with that problems, and they are called accruals and deferred. Accruals, of course, if it's paid in advance, and deferred if it's paid late. No, and this will allow to balance the balance sheet and the accounting integration of the situation into the accounting system. Question 1 is about leasing contracts, which are not part of the balance sheet. Two or 3 points here. First one is that if you come back 5 or 6 years behind us, means let's say 2015, which is not so far, you will understand that this question was not raised. Leasing contracts were not taken into account in the balance sheet because the balance sheet was a balance sheet based on the ownership principle. It means you were not the owner of the equipment. The equipment was not in your balance sheet, even if you pay regular rent, even if you use on a daily basis the equipment. The ownership principle was the only and simple rule to introduce an equipment into the balance sheet of the company. That means if you had a leasing contract, it was not, you were not supposed as the user to be the owner. You were not the owner, you were the user, you pay rents, and the material, the equipment was not taken into account into your in your balance sheet. The only element which was introduced in the accounting system was the rent. The rent were taken into account in the income statement and 100% deductible from the operating operational results limited to taxes. And in most of the accounting system, you found detailed information below the balance sheets on the leasing contracts. For example, maturity, for example, the interest rate, for example, the amount to be paid in the year to come. So this was the traditional position. So, second point, why it was decided to move the system, to modify the system? Just because it seemed to many practitioners and academics that to improve the system, we had to take into account ownership, of course, but also we had to take into account, who really used the equipment. Is it better to have the equipment integrated into the balance sheet of the user or of the owner? Do we need accounts based on the principle which is the ownership, or an accounting system based on the use, daily use of the equipment? And of course, we find the pros and cons. We find experts in favor of the first solution and the second solution. Today, at least in some cases, we can use the new rule, which is to introduce the equipment value in the investment in the balance sheet, in assets, in non-current, as we say, assets in the balance sheet. And on the other side, of course, we find the same value as a long-term loan. Of course, the structure of the balance sheet has completely changed if you do that for a company with using a large amount of leasing contracts. A good example of that are transportation firms. Many transportation firms in many countries use a large percentage of leasing contracts to finance their lobbies. If you keep only the ownership principle, you have a look to the balance sheet and you find 2 or 3 lobbies, they have both. But all the others, they have 90%, which are financed by leasing contracts, are not integrated there. But on the contrary, you find in the income statement high level of rents paid every year. You had a look in the courtyard and you find 10 times the number of lobbies you find in the balance sheet. So if you want to understand something about investments through the accounting contract, you need to modify that. And in that case, now firms are allowed, or in some countries it is even compulsory, to introduce their equipments into the balance sheet when they are financed by leasing contracts, at least if there is an operation behind. Okay, it means the balance sheet means there is a real set, and the set is used on a daily basis into the operations of the company. It's not a financial lease. Of course, if you calculate, for example, let's say several ratios on the balance sheet, they are completely modified. But probably they are closer to the real level. And it makes that the financial choice or tax choice between a classical debt contract and leasing contract has not to be taken into account, at least in the first analysis of the balance sheet. So means we have probably a better system than before. So remember, all principal leasing contracts are not introduced in the balance sheet. It means all the equipments financed by leasing contracts are not taken into account as assets in the balance sheet. All the amounts paid, rents on the leasing contract, are taken into account and deductible from the income statement. Second, we have new rules, but they are a bit complex because you have 2 cases, operational lease and financial lease, and more, they are completely, that means they have to be applied without any choice. In some countries, you have a choice between the old rules and the new rules in some others. So instead of bringing more homogeneity, there's brought more heterogeneity. On the other hand, it brings, last arguments, a better view of the real situation of the firm, the level of the assets compared to the total of the balance sheet, for example, of the net working capital also. And let's say it's more and more used in many countries. That's the trend. Okay, this is what I wanted to show you here on these questions. That's the kind of question you will find in your final exam, and have a second set of group of questions for the session number 2. This is what I wanted to show. So now I move, I go back here and I move to presentation 114, which is here. And if you remember what I said at the beginning of the course today, the beginning of the session today, I had prepared for you 8 different points. We went through point 1 and point 2 right now. And the next point is on number 3 here. So let's have a look at number 3. And perhaps after that you will get a break. So I hope, yeah. So number 3, I hope you see my slide here. If you don't, just tell me that you don't see the slide. We have, before moving to the income statement, we have here a few slides on net earnings, only 2, in fact. Yeah, okay. And after that, 1 slide on inflation. So I want you to be very clear on net earnings. Perhaps you are already, because you made that kind of problem probably in Pram 1 and Olivier Gozard courses. Net earnings, or what we call net earnings, net income, it depends if you are more British or American. Okay, it's the same. Okay. So the first point is that net earnings are split between dividends distributed to the shareholders and retained earnings kept in the firm and added to total equity. Okay, so net earnings at the end of the year, they don't stay there as net earnings. For amount of cash to be net earnings, it's a kind of transition between becoming dividends or becoming retained earnings. And we know that dividends are distributed to shareholders, and that retained earnings will be added a few weeks or months later to the total equity. Second point, the proposal of distribution. So how it works, what is the process to decide what to do with the net earnings? The proposal of distribution is prepared by the CFO and is presented to the CEO and the board of the firm. So first there is a step which is a kind of preparation of the decision-making process with different scenarios, hypotheses, analysis of consequences. And this is done in the financial department. So the CEO is responsible for that, and at the end of this analysis, there is 1 or 2 scenarios, you can have 1 or 2 or 3 scenarios anyway, to be presented to the CEO and to the board of the firm. And the CFO make representations, different hypotheses perhaps, and the board, with presiding over by the CEO, has to decide. They have to choose between the proposals. Perhaps the number 1 proposal of the CFO will not be accepted, but they will accept proposal number 2, or they will mix proposal 1 and proposal 2. So I think it can be accepted, modified, rejected, But at the end of the board meeting, there will be an official proposal of the management of a firm to the general annual meeting and to the shareholders. So point 3 here, the decision which has been accepted after discussion, presentation and discussion by the board, will be now presented to the shareholders during the annual meeting of the firm, or at least to the representative of the shareholders in the annual meeting, because in large companies with thousands of shareholders, only a few of them, or a few hundred, are showing up. Again, at that level, it can be accepted, modified, or rejected, even if you have a look to statistics, because we have got statistics on that one. In a large majority, very large majority, of course, I would say it's around 90%, they are accepted at this level. So now it has to be implemented, enforced, okay? And the CFO and his team, they are responsible for implementation, enforcement of a decision. So that's how it works. And from the beginning, from point 1 to point 4, you have generally several months. And very well organized companies, in the accounting and finance, point 1 is available at the end of February. But in most of the cases, point 4 is implemented only in June or early July. So that means there's about 5 months. It's a 5-month process here. Okay? Second, next slide. Also net earnings and net income. How is it paid? The dividend in general is paid in cash. It can be paid, so if there's no B, it can be paid in shares in some cases. So you have a kind of general solution, which is payment in cash. You have a specific solution, the payment in shares. Payment in shares allow, of course, an increase in the number of shares, and the fact that if 100% of the dividend is paid in shares, you don't have any cash to pay. There's no outflow. The cash is kept into the firm. Point to the payment in cash has for consequence a decrease in the cash level of the firm. So in many cases, analysts think it is negative, or mainly politicians think it is negative. And they think we don't know where the cash is going to. In case of a payment in shares, there is no cash decrease, what I said, and an increase in total equity and in the number of shares. In fact, it's very similar to an equity issue. Third point, retained earnings increase the total level of equity. Total level of equity is increasing. And this is what I said yesterday also. Many growth companies, have a high return, and they can distribute dividends, but very often a large percentage of net earnings stay in the firm as retained earnings. It means, each year there is an increase, which can be very important in the total level of equity because retained earnings are important. And in most of these cases, these companies never go on the market or to their shareholder to ask for a new equity issue. It's enough to finance the growth and the new investment. Point 4, which is something interesting also, it's a good introduction to elements we'll see later. These decisions are analyzing the financial theory as signals. The word signal in finance is important. All the announcements, all the decisions are interpreted as signals. It means there is a meaning behind, as signals given to the shareholders in the financial market. And very often, the distribution of dividend is something which can be useful in case the CFO wants to issue a large number of shares in the next future. You will see that later in the biotechnology case. It is clear that in the biotechnology case, the firm needs new cash. They need an increase in equity. And you say, okay, if they need an increase in cash, why to distribute dividend? We are better first to keep this cash amount and to keep 100% of the net earnings and to transfer them in total equity through retained earnings. But if you analyze the situation, you will say, okay, perhaps it's better, if you need a large amount of cash to issue share, but you have to prepare the market and you have to prepare the shareholders to your future demand. It means if you want to ask cash to one person, one customer, you have better to give him something before. So if you need 1,000 euro for an equity issue, perhaps it's not so bad to distribute 100 or 200 of dividend 3 months before. You will be more successful in the second part, which is the most important one of your deal. So signals of a signal of brought by the distribution of dividend in both firms is very often a signal of potential future in the short term, future but in the short term equity issue. This is the announcement of the equity issue. I will come back on signal theory and the application of signal theory, because in that case also, financial theory is very close to financial analysis and to decisions on net earnings and on equity issues. So this is what I wanted to show you here. We'll come back on these points, later with the biotechnology case, which is a growth case. I can tell you it's biotechnology, it's growth, it's high return with the need, increasing need for cash. After net earnings and net income, I should come back to my structure. We have been through 1, 2, 3. Let's have a few words on point 4. And after that, we'll make a break. Point 4, in fact, it's not slide 4, it is slide 6. The question here is a question which is raised, in the between financial experts on financial markets, CFOs, and so on. It's about inflation. We had years. It could be different in emerging countries, but there's many of the largest markets in the largest countries. We have a low inflation rate, well, for what, nearly 20 years, right now, 25 years, even in some countries. But we don't know what is happening right now. What we know is that we have a pandemic. You know that, as we did. Okay. And it seems that some indicator, in particular what we call advance indicators show an increase, substantial increase in inflation. So if you read my point number one here, inflation can be back with or after the pandemic. The available data show an increase, but is it short-term only? We don't know. It seems that the market believe at the moment that it is short-term. It's an increase of inflation rates, at least in some large countries, the driving countries in the world. And you understand that the feeling of the boards.
Professor,
yeah.
I'm sorry to disturb, but you are seen in the slide 19.
Slide 19.
Yes.
All right. Let's try. Something new?
No, it's still the same.
I'm supposed to be on inflation here. And now, any change?
It's
Yes,
okay now.
it's a slide 6, financial analysis, inflation. Is right?
You're right.
Yeah.
Yeah, that's the right one. I'm sorry for that. So don't hesitate to say something when I'm wrong, you know. So on this slide, you know, when I show you, I want to show you questions which are raised in terms of financial analysis because of the inflation or potential inflation increase. Point one here, inflation can be back with or after the pandemic. If you have a look, you know, to the available data, they show an increase. But the question is it a short-term increase only of inflation rates in some large countries? Does it mean we are back in an inflation state for the world economy as we had in the 70s and the 80s? Or is it only a kind of increase of inflation rates for 3 months, for 6 months? You know, after that, it will come back to normal being the situation we have known for the last 20 or 25 years. That's the question. And of course, the answer to this question given by the main central banks, like the US federal system, the European Central Bank, the Japanese bank, the Chinese Central Bank, the British Central Bank, and so on. You know, it's very, very important because in case they believe that it is a long-term growth of inflation rates, they will move their policy in terms of liquidity availability to the markets and to the firms and to the banks, and also their level of interest rates. If they don't believe that, even it means if they believe it's just a short-term movement at the end of the pandemic, but nothing else, and will come back to normal, they will not move. For a long period of time, the present policy of low interest rate and high liquidity level afforded to the different players of the economy. And the consequences, of course, will be very different from the different players, for the growth rates, for returns of the firms. but also for the quality of your accounts. Because if you go to point 2, you will understand that inflation has consequences on the accounting system. It means, for example, that you have bought, 3 years ago, production equipment. And this production equipment, as we know, has been introduced in the accounting system without VAT at the level of the price paid without VAT at the time it was bought. If you have something like 8 to 10% inflation rate for 4 or 5 years, it means that prices, will probably move that by something like 35 or 40%. And if when on the secondary market, perhaps your production equipment will have a higher value than the value you introduced to the market at the time you bought this equipment 4 or 5 years ago. So, inflation raises problem of quality of the accounts. If an accounting system is just to summarize all the operations, but with dots on the values integrated, it loses part of its usefulness. And it becomes very difficult to use to measure, returns or debt capacity, for example. And the question is, do we have that kind of experience? And the answer is yes. We had long-term period of inflation in the world. And of course, accountants and experts and regulators tried to adapt to that situation. And we introduced inflation rules. Inflation rules, generally in the middle of the 70s in different countries. You should remember that in the US, when President Reagan became president in 1980, the interest rate, 10 years government bond, which is reference in the US, was 20%, and the inflation rate a year was 16-17% a year. So they had to adapt. So what's happened in that case is that we were unable to find a kind of global system. The different measures were introduced in different countries. We have experiences, but we never adapted or took the lessons from these experiences in order to design an accounting system which is adapted to an inflation world or an inflated world. So the question is there. We know that there is an influence on the accounts, which is such that the accounts lose part of their meaning and their utility, but it's difficult for financial analysis to measure returns or to measure debt capacity. That means that the quality of financial analysis will be lower than what they are still now and what they were for the last 20 years. So it's more a question mark, an open discussion, which is there, but you have to think about that and to understand that if the world is changing in terms of inflation level, this question will be an important question. So this is the first part, the second part, what I wanted to do today. After dealing with the last part of what I expected to deal with in session 1 on equilibriums, technical questions. So I went through 2 points here. The first one being about questions about net earnings, net income, and the second one, questions about inflation. Now it's time for a break, and then we move to income statement. Okay, this will be my next point, which is here. I think so. I don't know why it is too. My function, yeah. So let's have a break. Let's have a 10 minutes break, please. Now, yeah, it is here. It's number 7 for me. Yeah. So let's have a break, and we start after the break with the income statement presentation, explanation, and discussion. Thank you. 10 minutes break, please. Bon, allez, on va recommencer. Okay, so I think you had your 10 minutes break as usual, and now it's time to move to the last part of this session. And in the last part of the session, it will be mainly concentrated, dedicated to income statements. And I will make a presentation on income statement as I did on the balance sheet, in order we are clear with all the hypotheses behind and the presentations which are also available. So you have a first slide, and I hope you read the first line because it's called income statement 1. And the first point here is what is an income statement compared to a balance sheet? The balance sheet is a kind of picture of the financial situation of the firm at a point in time. And 2, an income statement summarizes the company operation during a period of time, in general 1 year, which means it records revenues and expenses over a period of time. Revenue and expenses over a period of time. Okay. And 3, an income statement also helps investors and creditors to determine the past performance of the business and to predict future performance. It's more performance oriented than the balance sheet, less probably also oriented towards risk prediction. We find different presentations of the income statement, but only 2 of them are used by a large number of firms and countries. To put it simply, we have the US presentation with gross profit, operating income, which is a grouping by function. And you get also the European presentation, which introduced at the beginning, EBITDA, EBIT, grouping by nature, and which is also the source of the approach of the IFRS standards you have, at least for some of you. Now, if I start with the American style, let's say, which is in fact the presentation by function. The main element we know here are the gross profit and the operating income. And it is organized by function. Okay. Sales, distribution, administration, finance, and so on. Okay. If you have a look to the different data here, you understand very quickly that some of them will be very close to the data which are included in the other presentation, sales, of course, and net income, of course. So it's not a difference, you don't find a difference between the basis revenues, the sales, without taxes, or the last bottom line, the net income. But you find different presentations between the first line and the bottom line. Cost of sales, you know, it's quite complex to estimate because it integrates, you know, many different elements. Administrative expenses also, but we have a good vision, good analysis of the different level of expenses in the firm. If you have a look to what is an operating income, it's very similar, in fact, it's equal to an earning before interest and taxes, to an EBIT in the other system. And after that, you will see that the presentation is identical between the US and the European, by function and by nature presentation. So the differences are here between sales and operating income. This one here, the US or by function one, is very close to the analytical accounting system of a firm, which is also a cost accounting system. The other one, I will show you that in a minute, it's much closer, you know, to national accounting. So the influence at the beginning isn't the same. It's a cost analysis by section here, by department, by function. On the other side, it's closer to the national accounting system, which is based on the nature of the expenses. Next one here is what we call the continental or European one. Of course, you find the same level of sales, same level of net income. You find the EBIT, which is equal to the level of the operating income on the other presentation. But now you have a distinction, which is not by function, but it is by nature of the expenses. Inventories, raw material, consumable, wages, benefit expenses for employee, and so on. Now, if you want to go further, it's okay. Do we have only two systems? We have two basic systems. Okay. But in some countries, you find a mix between the two systems. Or you find a situation or decision by the regulator which has been to have a presentation of the upper part of the income statement according to the two presentation. By nature, which is the European one, which is somewhere here, and by function, which is the US-based one. But we have also another presentation, which is an introduction of the added value in the system. And in fact, the added value is introduced. You can have a look, for example, here by nature. The added value is the difference between what we call in national accounting systems in Vietnam and in other countries, production, which can assimilate to sales level, and consumptions, which are mainly raw materials and consumables used. It means if we introduce the added value here, it will be on the fourth line here, between the raw material and consumable used, which are consumptions, and the employee wages and benefits expenses, which is part of the distribution of the added value created in 1 year by the firm. So what is the interest to introduce the added value here? And why do we care, particularly in some countries, with the added value? I would say first, because when you get the added value, you know what is the value created by the firm and brought to the economy as a whole. Okay? It means, and this is point one here, added value is a macroeconomic concept. You will say before going further in 2.2, but when you heard about added value, it's either because you had very good courses in economics, which is perhaps the case, and or because you heard about added value through taxes. Added value is the basis of taxation of the firms today. It is generally the most important tax in the country. And the VAT is value added tax. Okay. It's a tax on the value added to the preceding elements of production or consumption. So it is clear that it's important for tax measure, tax calculation, and it is important, of course, also for the finance authority in the country, because when you know the tax rates and when you know the added value of each firm, you have a good, at least, proxy of the amount of taxes which will come, which will be available for the government. So there is a tax issue there. Point two here is that the GDP of a country is related to the added value as something between them. The GDP of a country is a total of the added values of all the companies located on national territory. It means if you take the value added by all the companies located on the Vietnamese territory, whatever they are, state-owned, family-owned, foreign companies, joint venture, whatever you want, if they are small, large firms, they are taken into account in the calculation of the total value added by the companies in Vietnam. On the contrary, subsidiary of Vietnamese companies with a headquarters in Hanoi or Ho Chi Minh City, but located in Singapore or located in Bangkok or in another country, they are not taken into account in the calculations. So it is a geographical basis, which is the rule, basic rule for the calculations. It's not a question of ownership. So the added value by all the companies located in Vietnam are added, and the result is the GDP of a country. And when you hear point 3 about the growth rate of a country, when you hear on the TV or radio or something else, Minister of Finance saying the growth rate of Vietnam now is going up by 2% more than the expectations we had in the last budget, you know. What does it mean? It means that the civil servants are following the added values produced by the companies located in Vietnam, and they are making comparison of what they obtain and what was forecasted, you know, or what was produced in terms of GDP and added value the year before. And the increase of the GDP and the increase in the growth rate of the national economy, which is announced by the Ministry of Finance, you know, is due to the fact that the calculation shows that the total added values has increased more than expected. So the growth rate of the country is based on the growth rate of the GDP, and the growth rate of the GDP is in fact the growth rate of the added values of all the companies within the country. So, you know, for the authorities, political and economic authorities of the country, it is clear that added values are very important for tax reasons and also for growth measure and announcements. Point 4, added value can be introduced into calculation in an income statement, or can be calculated as a margin, in fact, in the income statement. It is production minus consumptions. With the example we had here, this is with the European presentation, we have a sales level. If you deduct changes in inventories to finished goods and works in progress, and then raw materials, and all consumer goods, including transportation, for example, which are used, you get the added value. And then you will deduct, you know, all the wages and benefits given to the workers' staff in order to find, you know, the EBITDA. So that's how it works. And that's the usefulness of the added value, and it can be integrated easily, in fact, in income statement, at least in the European presentation. It's a bit more difficult in the US-based presentations. Now, small points for discussion here. You know, very often, you know, many people think that firms with high added values will show high net earnings and high returns, and that on the contrary, firms with low added values will show very low returns. In fact, it depends very much on the economic sector and the structure of a firm. If you have a look to consulting firms, for example, consulting firms, they have high added value. Why? Because generally inventories are very limited or close to zero. And also they have consumer goods taken into account. But it could be mainly offices rent. It could be transportation, but it's limited. So that means that added value are very high in terms of percentage of the total. So that's the consulting firm. And what's happened to the added value? Added value is mainly distributed to the staff through salaries and other benefits, and that means this is the most important element, of the income statement. Net earnings are really depending on the policy in terms of human resources and the productivity of the teams, not of the other kind of expenses. We have high added value, but with high added value, we can have high net earnings or low net earnings compared to different standards of consulting firms or general standards. If you have a look, I've kept some small customers also for years as a consultant, not only small, but some small consultants. I've been working for years for a firm, which is a trading firm, and dealing only on two products, tomatoes and apples. And when you have a look to the structure of income statement, the added value is very small compared to the level of sales. Because, what do they do, in fact? They buy and sell two products. And they do that with large quantities, large volumes, with a very limited number of persons. There are 5 working there. Okay. And that means the two largest lines in the income statements are the sales level and the product, basic products, original products, the apples and tomatoes. After that, there is nearly nothing. That means if you have a look to the added value is very, very low. It's something like 12% of total sales. And after that, of course, you find the net earning level, which is about 4 to 5% of the sales level, which is not so bad. But now, if you have a look to the return for shareholders, it means net earnings compared to total equity, it's about 40%. And it has been 40% for the last 10 years. But it doesn't mean that low added value, bring low return on equity. It depends on the structure of a business model. And this is a good example to show you that. So added value are useful, are necessary for governance, are indicators, which has to be followed in the very short term by the authorities, economic authorities of the country for growth policy and for fiscal policy use. But, the level of added value is not a good proxy of what will happen in terms of return of equity. You can get high return or low return. It depends really on business model. Okay. Now let's move lower into the ratios. So we had already a short introduction of ratios with net working capital, operating working capital. We had 3 of them. We find more here, very classical ratios with a limited number of elements. The first one is net earnings on total sales. Net earnings on net income, depends if you are American or British, okay? Divided by total sales without VAT always. And it gives you the number of cents which are at the bottom line, in the bottom line, and which are left when you have paid all the expenses and compared to the level of the sales. Okay? It's very different from an industry to the other. And even in one industry can be different from one product or one market to the other. Take another example. You have a look to the luxury industry. Generally, ladies know that. You find the luxury shops in your 2 largest cities, Ho Chi Minh City and Hanoi. And I think partly to Louis Vuitton, Moet Hennessy, because of course Louis Vuitton products and bags are known by all ladies of the world today. But in the same group, Louis Vuitton, Moet Hennessy, they produce, Vuitton, let's say mainly bags. They produce champagne with Moet, cognac with Hennessy. They produce also perfume with Christian Dior. Okay, and if you have a look to net earnings to total sales, even if this number, this ratio for the group is very high compared to many other industries, they are very different. So the net earnings of the total sense for the group as a whole is about 18%, which is very, very high compared to many other activities. But it means it is about 12 to 13% for the champagne, it is 8% to 9% for the cognac, and it is something like 40%, 40 for Louis Vuitton products bags, So you cannot really compare activities, because if you do that, you will say, okay, I'm Louis Vuitton Moet Hennessy CEO, I will sell my champagne, my cognac, my perfume, and keep on the bags. But you understand that for some business model reasons, it's not the right solution. You have a portfolio effect, you have fixed costs to take into account, for example, you have customers and they want not only your bags, but also your champagne and your perfumes. So it's a bit more complex than that. It's a good indicator, but it has to be used carefully. The second one here is probably more interesting and easier to interpret, which is the EBITDA divided by total sales, because in that case, you eliminate, of course, the policies, financial policy, interest out of there, dividend out of there, and also the depreciation process. So it's really production minus consumption minus distribution by wages and benefits to the staff. And you can better compare different activities using this ratio. The third one is EBIT. It means in that case, the difference is only the depreciation and amortization level, which has been taken into account, which is very common, which is also used in the US-based system. You will find that very often. Two other analyses are very often done with simple ratios. The first one is to try to have some comparison over time and also to have some comparison between firms for employee wages and benefits. And depending on the analysis, employee wages and benefits are compared either to the total sales or to the added value or to the EBIT, sometimes to 2 or 3 of these data. So we are here with another analysis which is very carefully done, because in many activities today, employee wages and benefits is #1 expense, So a small difference, a small improvement increase tremendously the level of the returns. Of course, finance or financial costs, which are mainly interest here, are also compared to the EBIT, to a total sales, or to the added value, same system, and give you an idea of what is brought to banks, mainly on the value creation of a firm. Let's say that today it's probably not as important as it was before, because when the interest rates, are 2 or 3 times what they are right now, that's become, very central expense, which is not the case in many firms, even with high debt level, because they have the opportunity to borrow at very, very low interest rate. So what you find here is a checklist of the main ratios used with the data produced in an income statement. It will be part, and we reintegrate that into our global methodology of financial analysis. Okay. If you have a look to your main reference, which is Burke and DeMarzo, chapter 2, page 45, Key Financial Ratios, we will find a table of ratios. I will use it step by step in the next session and compare them with other approaches, okay? And this is mainly based on the American experience. And among them, you find for the income statement, a category, a specific category, subset, if you prefer, of a list of the ratios. And this list of a subset includes 4 main ratios. The first one is called the gross margin ratio, gross profit of sales. The second one is called the operating margin, operating income of sales. The third one is called the EBIT margin, which is the EBIT of the sales. And the last one is the net profit, net profit margin, which is net income of the sales. If you think to what this means, it's we are close to what we said a few in the preceding slide. It is clear that EBIT of the sales is the same one. Operating income also, because operating income is a bit low. And net income is net earnings. So there's only one which is a bit different, is gross profit, which doesn't exist in the European system of the sales. So the conclusion here that the words are different, but the content is identical, very similar, and there's only one difference, which is due to the fact the expenses in the upper part of the income statement are classified, ranked in a different way in the two systems. So this page 45 will be probably very useful for each of you, and I recommend you use it regularly. You are a bit lost with the ratios. I was here with number 12. After that, I have two slides, number 13, number 14, and then two others, which are 15 and 16. Okay. Number 13 and 14 are on something specific, which is market value to book value. I will prefer to start now with part of the slides 15 and 16, which are again exams questions. I will try to deal with you with perhaps the easiest question after what we did yesterday and today. Perhaps I will keep some of them for next time. I'm on slide 16, financial analysis exam questions, and it is 4. Yeah, we are the two first slides in session 1, and we have number 3 and number 4 on exams question here at the end of my presentation on session 2. Okay. Let's have a look first. So exam question 4, which is slide number 16, according to the PowerPoint system. The question anyway is the operating working capital, or WC, as you know, of a firm can be negative. When does the situation occur? Is it good news for a CFO? Another question. Of course, it can be negative, and we already said a few words on that, saying that for the distribution sector, very often, most of the cases, it is negative because of a specific situation with very low level of inventories, nearly zero credit given to the customer. It means receivables are very close to zero plus. And on the other side, you have a high level of credit brought by the providers. So when you make a calculation of the operating working capital, the result is high in terms of absolute value, but with a negative sign. Okay. So that's the best example. And the second part of the question here is it good news for a CFO? And I will say it's not only good news, it's a dream. When if you are a CFO and you are trying to improve your operating working capital and have a positive operating working capital, generating risk of negotiations with the banks and reducing the returns for shareholders, your dream is that you can move your very positive operating working capital to a -1. Of course it is, because with a -1, you are completely independent with the banking system. You can finance part of your a large part of your investments using the cash issued by the operating working capital. You can reduce the level of total equity and offer a good return to your shareholders. So the negative operating working capital, which is characteristic of few economic sectors and particularly of the distribution sector, is good news and is a kind of dream for CFOs. I told you I've been living in food industry for 5-6 years, and each year we had a plan to reduce the operating working capital. For what kind of reason? 1 year it was to reduce the raw material level. Second one, to reduce the intermediates inventory. The third one was to reduce the provider credit given to a provider, and so on. To extend actually the credit given to a provider and to reduce the credit given to the customers. So it's always a topic which is on the table. And the dream is to obtain a kind of negative operating working capital. This is the first question, which is a simple question. You have to understand pretty well what it means. The second one here is just what we have done. In the continental European presentation of the income statement, the added value is calculated before the EBITDA, just what we have done. Take production minus consumption, we get the added value, and then you deduct the wages, benefits to the staff, you get the EBITDA. And the question here is this margin more important to the shareholders and to other stakeholders than the return, than the return on equity? This is the question. Than the return on equity. Explain this. Clearly, is no. The shareholders don't take into account or are not interested in the added value. They are interested in the return on their investment. And what is the investment? Is the level of total equity. So they are interested by the improvement and growth of the return on equity. And as I try to show you, you find different cases where we have small added value and very high return on equity. So there is not a kind of clear link between added value and the return on equity level. There is a link somewhere in terms of calculation, but not in terms of level. Okay. Other stakeholders, this shareholders and other stakeholders, and the question could be, the answer could be different. Some of the stakeholders, they are customers, they are providers, they are local authorities, the state, unions, and so on. Now, they are interested in having high added value, and they are more interested by the added value perhaps than the return on equity. Unions, for example, why? Because with high added value, generally you have necessary cash to pay a large number of workers. So you don't look very much for higher productivity of the workers. You get sufficient cash to do that. So that's good news for the unions. Second case, of course, is the state. And that's what we said. State and the local authorities, Ministry of Finance, they are stakeholders. And they are interested in 2 points. First one is the level of taxes paid to VAT. The higher the VAT, the higher the added value, the higher the VAT obtained by the government. So good for the budget. And the second one is growth. And of course, growth is a key point, a key indicator for government and state, because a higher growth, that means higher GDP, it means capacity to develop employment, to invest in infrastructure, invest in education, to invest in hospital, and so on. That means better standard of living in the country and better development also of the country. So for shareholders and part of the stakeholders, the situation is different. For shareholders, it's clearly much more important. ROE is much more important than added value, which is not the case for some of the stakeholders, and particularly for governments, and because of the impact of the value added tax and the level of the GDP and the growth of the GDP. Third, net earnings are split between dividends and return earnings, of course. Explain how the decision is made. Identify the different steps of the process. Okay. What are the accounting and cash consequences? And cash management consequences of a decision. So it's very simple. I explained that. I think it was, I hope it was clear at least, the decision in the process of management of net earnings is a several month process, something like 5 months in average. That means first, the study is made by the finance department, and they may have a proposal or 7 scenarios. This is brought second to the board, presided by a CEO, and the board either adopt the scenario which is proposed or one of potential hypotheses, or reject them, or make a mix, or adapt one of them, taking some elements of another scenario. But at the end, they have their own scenario. That means the management of the firm has got a scenario, has got a potential decision which is presented to the shareholders, at the next annual meeting. This is what it means. And the annual meeting, it means the shareholders or their representatives will discuss again and decide of the final decision. And the final decision will be net earnings, which has been accumulated at the end of the period, the last period of time, last year, will be split between 2 elements, retained earnings and dividends. And dividends, for example, would be 40%, and retained earnings would be 60%. After that, and this is the last step, there is a problem of implementation, enforcement, which means that the CFO and his team is in charge of that. And the consequences are that for the part of net earnings paid in dividends, there is a cash outflow. It means a reduction of the cash position of the firm. And for the other part, retained earnings, on the contrary, there is an increase in total equity. So it seems that in terms of cash and accounting position, if you analyze the situation without, taking into account the dividend, the shareholders, the next financial operations, market value, and so on, you will think that firms are better not to distribute dividends and to keep 100% of the net earnings into return earnings and to move that amount into the total equity. But now, it is okay, but we need to have total equity. And if you want to keep shareholders, if you want to be able to catch new financial resources with equity issues, we are better to take care of our shareholders. To take care of shareholders, it's perhaps it's to give them information, it's to meet them, but it's mainly to pay them, and to pay them is to give them dividends. Which means that if you are a growing company which needs like biotechnology, which needs new issues in the future, you have perhaps better to distribute dividends a few months, 1 or 2 years, before going through a process of equity issues. So, in that kind of answer, an analysis issue should not be only short term, and you have to take into account the decision over time. You have to take into account the relations with shareholders in the stock market. You have to understand also that the distribution of dividend, which is a good and positive signal, will probably have an impact on the market value of the firm and will facilitate later the success of an equity issue. So this is what you had to explain in these 3 questions. Now, I will keep the 2 other topics, first market value to book value, and I need a few minutes with an exercise to go through that with you, and also another set of exam question, which is set number 3. Just what I want to perhaps to summarize at the end of this session is the following. What we have done today, we were back on session 1 topics, short summary of all of them. We went into more details in points 6 and 7 of the last presentation, session 1, because we had no time left to deal with these points last time. We discussed about net earnings and what to do with net earnings, what it means, what is signal theory. We can come back at signal theory later. What is the process of decision, to allocate the net earnings? What are the consequences in terms of the accounting system and in terms of cash management? We said a few words about inflation, and the question raised by inflation, distortion in the accounts, and the difficulties of the accounting system and financial analysis to integrate inflations, not only the level of inflation, but also the acceleration and decrease in the level of the inflation rate. 5, it was a classic representation of income statement with 2 main framework. First one being the American one, second one being the European one. One is by nature. The second one is by structure. And then we move to added value and try to show you that it could be a margin, at least in the European-based system, and that instead of being connected to cost accounting, and analytical accounting if you prefer, like the American system, American presentation, it is connected to national accounting. And it is useful in that case, for some of the stakeholders and partly from the state, because of the importance of the value VAT and the importance also of the data on GDP and growth of our GDP. Last, we went through 3 different questions. It was the last slide of my presentation today. with topics which were also topics that we dealt with. First one, on the operating working capital, something which is very central for the management, financial management. Second one on the European continental presentation and the impact, of the different margins on stakeholders or shareholders. And the third one on, again, on net earnings split between dividends and retained earnings. So that means here in this today presentation, we have left, a few points. In fact, points number 7, market to book values. We'll deal with that tomorrow, starting with this topic tomorrow. And then we have also to come back at the beginning on one of the last 2 slides on exam questions. And after that, I will move to other elements, other topics, and mainly to ratios. The first session was really concentrated on balance sheet and equilibrium. The second one, we moved from balance sheet and equilibriums to income statement. The third one, we'll move from income statement to ratio analysis. So thank you very much for being here tonight. I know that it's difficult in Vietnam right now, and be careful, and I hope to see you tomorrow night. Have a good night and dream about financial analysis. Good night. Goodbye.
Goodbye, Professor.
Bye.